This is Mastering Your Wealth with David Gagnon, the podcast.
We are seeing headlines with warnings about significant stock market pullbacks. Ray Dalio is the CEO of the hedge fund Bridgewater, which manages about $90 billion. He quoted an ancient Chinese proverb that said, "A smart rabbit has three holes," which really means when trouble strikes, you need to have options. So, David, do you create your retirement plans with an exit ramp out of the market, or how do you describe it as far as having options?
That proverb is a powerful way to frame retirement planning, because most people don't fail due to one bad decision. They fail because they didn't have options when conditions changed. So when clients hear exit ramp, they sometimes think we're talking about timing the market, jumping in and out of the stocks. That's not what this is about. It's about not being forced into decisions at the worst possible moment, because you can never time the market. And that's where people really create some costly mistakes when they are making their financial decisions emotionally. I'm thinking about a client couple that we worked with a few years ago, and they came in with almost all of their retirement assets tied directly to the market. And we see this more often than not, because people gravitate from their working years, which are their accumulation years, from a growth objective of their money now into their income distribution years in retirement. So that's an income objective. So they had no dedicated income strategy, no buffer. Their plan worked fine when the markets were doing well, but when the markets were starting to lose value, they were selling off more shares, and this is what we refer to as sequence returns risk. If you have a downturn in the market, especially in the first 5 years of your retirement, they would spend down their nest egg faster because they're selling off shares at cheaper prices. And we educate folks when we do their planning to show them what sequence of returns risk can do in derailing in retirement prematurely. And this could be in 5, 6, 7, 8 years, depending on how bad the market experience was in their early years of retirement when they needed to take those funds out. And so they didn't have an answer because they didn't have a second or third rabbit hole, just like we were just talking about. This was their plan, and they were all invested in the market and trying to create a paycheck from a volatile portfolio. So income sources that don't depend on daily market prices is important to have as part of your strategic income plan. A cash and short-term reserve so you don't have to sell assets in a downturn is pretty important. And long-term growth money that you don't really need to generate income from now can stay invested without panic. So we strategically design these income plans so that we align your investments with your income needs, and we look at tax-efficient distribution methods. So tax planning is a major component to have efficiency, so you have more money in your pocket and less money paid in taxes. And so I'll tell you, a good retirement plan really isn't about escaping the market. It's about knowing when you don't have to rely on it. And make sure you have a strategic, personalized income distribution plan that's aligned with your income needs and your timeline for when you're going to need it. And usually we build them out for 30 years. So if you're struggling with trying to create income and you're in retirement, give us a call. We can have that discussion about whether there might be a better structure in place and give you better predictability and alignment with your investments to produce the income you need without the worry of the market.
And again, that phone number, 203-872-0009, 203-872-0009. Don't forget about that website again, masteringyourwealthradio.com. Now, we talk about it all the time. The number one fear when it comes to planning for retirement is running out of money. So how do you avoid that? Well, there's three famous ingredients that you need in retirement. It's income, and, of course, income. So now the question becomes, how much can you spend each month when you begin retirement so that you don't run out of money? Christine Benz at Morningstar says they took everything into account and came up with this percentage pool for 2026.
We came out with 3.9% as a safe starting withdrawal for people who have an approximately 30-year time horizon. But my hope is that people don't just take that 3.9 or 4% and run with it, because in many scenarios that will lead to significant underspending and really depriving themselves of a better quality of life that they could otherwise have.
So, David, she went on to say that, flexible spending strategies might work better than a percentage number for withdrawals. Can you explain what she's talking about here? And is that something that you use for new retirees? Or what, if not, what's your process?
Well, this is one of the biggest mindset shifts retirees have to make, and one of the hardest. And the idea of a fixed percentage sounds safe because it feels scientific. But real life isn't that tidy. Markets don't move in straight lines and spending doesn't either. And so flexible spending strategies acknowledge something very human. So people don't spend the same every year in every way. So this became clear with somebody who worked with a while back. She retired at age 66. On paper, the percentage rule worked out fine, but emotionally she struggled. So when markets dipped, she felt guilty spending, and we see this often. And when markets rose, she still didn't feel confident because she wasn't working off of a plan. So instead of anchoring her retirement to a rigid number, we anchored it to priorities. So we made sure we covered her essential expenses by a predictable income stream. That was one component of her plan. And as far as discretionary spending, we were able to adjust that based on conditions of how the markets were doing. And we had some excess accumulation going on for some income sources we built in for discretionary spending. And then we had guardrails on her money instead of handcuffs. We had some safeguards, airbags on the money, so that her growth component in the portfolio still had some downside protection. So the downside of a pure percentage approach is that it ignores sequence of returns risk. For folks that are in the market and they're relying on those market sensitive investments, as we were just talking a few minutes ago, it works okay when the markets go up in value, but when the markets drop and lose value and you have to sell more shares of what you need to create a check for, you could prematurely exhaust your retirement before your retirement's over or your life is over. And so we always incorporate safeguards so you don't incur sequence of returns risk, because we're going to invest the money that's aligned with the income needs. We're going to use alternative fixed income tools or income tools that provide consistent higher yields than what people traditionally might use, such as bond funds. And so there's flexible strategies that are important to have built into your planning. And spending more confidently after strong periods is easy, but you don't want to be in a position where you have to wait for the markets to cooperate so that you can spend more. You want to have a strategic plan that's aligning different buckets of your money for different timelines and predictability of your cash flow. And so for many retirees, especially those with Social Security, covering a meaningful portion of their expenses and flexible strategies can actually lead to more lifetime spending, not less, because we can give them validation as to what they can spend with a plan. So when they're working off of a plan, they're comfortable. They know where the money's invested, where it's going to come from, and they don't have to worry about the noise about the market and what their investments might be affected by. We want to take the emotions out of these financial decisions and create real solid strategies with the right investment tools so that people have the confidence to spend what they need to do to maintain their lifestyle. And that's what we bring. We bring the clarity that they need so their spending can be at a level that allows them to enjoy their retirement.
So for those listening that go, I love everything that David's talking about here. I want to take the risk away. I want to make sure there's clarity. I want to make sure that there's a plan B and C if I need one to the plan A. How do I get started? How can he help me? What do you say?
What I would recommend is let us do your portfolio analysis first. We talk about this comprehensive analysis all the time, and what we're finding is people have their investments in the wrong places that aren't aligning with what their current income needs require. And so when we do these plans, we're able to show folks things that are available to them that they never knew existed to allow them to lower their risk, increase their yields, have more consistency in returns. And this is a big factor in successful income planning. So if you're really trying to create a paycheck from your investment plan and you don't feel confident that you're not overly exposing it to market risk, give us a call. Let us do that comprehensive analysis and give you some feedback on what's working and what isn't.
Again, for this comprehensive analysis, give a call today. It is complimentary, 203-872-0009. That's 203-872-0009. Just a reminder here, guys, David's been in the business nearly 40 years. He's obviously a great wealth of knowledge to sit down and speak with and, of course, implement and put that plan together for you. 203-872-0009. And again, that website, masteringyourwealthradio.com. This is always a popular question that you get is, hey, what do I do with my 401k when I retire? Well, According to a recent study by Vanguard, within 5 years, half roll over that money into their own IRA, and another third, well, they just cash it out. And only 17% stay in the actual plan here. So what are the ups and downs of keeping your money with, your current 401k provider while in retirement? Just seems kind of weird. You move on, but the money stays behind.
This is one of those decisions that looks simple, but has long-term consequences. So there's no universal right answer to this, and that's where people get tripped up. I had a gentleman a few years back. His employer plan initially made sense to him, and that's where he was planning on keeping his money for the rest of his retirement. The fees were low. It gave him time to breathe and make thoughtful decisions instead of reacting on the last day of work. So people are comfortable with their 401ks because think about it, they might have been contributing to that plan for maybe 10, 15, 20, 30 years. That's their little baby. So it's hard to part ways with that plan to move it to something that's entirely different. But over time, limitations become clear with these 401k plans. You have fewer distribution options in many of these plans. You have less flexibility with withdrawals. And now we deal with federal employees, and their TSP plan is not a very good retirement plan when you're looking for flexibility and distribution options or investment options. So limited investment choices for specific retirement needs might be limiting in a 401k plan, especially if you're trying to create income. And on the flip side, some employer plans are improving. They're offering flexible withdrawals. They're providing advice. Some are even providing some income solutions. Now, some other plans lag behind. So that's why we don't default to roll it over or leave it alone. We evaluate fees versus flexibility, which is very important. We look at income needs versus accumulation designs. We want to see what the control is versus convenience of where you have your money invested. And what about a tax and withdrawal strategy? Does it create the ability to have the flexibility in being tax efficient in your distribution planning? So, cashing out early is usually the biggest mistake. Some people do that. They actually take distributions not knowing the tax implications and the penalties that might go along with that. They lose the compounding permanently when they damage their retirement by taking these distributions prematurely. So, the right move is the one that supports how you plan to live in retirement, not just where the money happens to be sitting. So we always do these investment portfolio analysis, and we look at all the different advantages or disadvantages of what a 401k plan might do to complement your plan.
203-872-0009. And again, that website, masteringyourwealthradio.com. The average NBA player makes, just pocket change, $11 million a year. So why do 60% of players go broke within the first 5 years of retiring? Well, here's Hall of Famer Shaquille O'Neal.
Sometimes you just get so much money and you forget. Like if you got a 5-year deal worth $100 million, you're making 20. If you spend like 20 in the first year, you'd be like, you know what? I got another 20 coming. That's how guys are thinking. I always tell them, don't think about what's going on now. Think about what has to go on in the future.
That's good advice, especially with that kind of money coming your way. How can the same mistakes happen with just everyday retirees, David?
Well, this story isn't really about athletes. It's about structure. Most players assume money will last because it's large. Sometimes their spending goes to the threshold of what they're earning. So they might live above their means at that point because they see more money coming in later. They don't build income systems, and that's so important. And that's what Shaquille O'Neal has done very successfully for many years. He's got all kinds of income systems coming from all these different business ventures. He's smart. He's a smart businessman. They don't manage spending early with these young athletes, and they never had that kind of money. So they can get a little careless with it, and they underestimate the taxes they got to pay on it. And they assume success will continue indefinitely. But one bad injury could shut that all down. That's what you're at risk for in many cases when you're an athlete at that level. So everyday retirees make the same mistakes. It's just with fewer zeros. And we see this quite often. I had a client that came to us a few years back who retired with confidence after strong market years because we've had a pretty good run up in the market. The danger wasn't overspending. It was unstructured spending. And without a clear income plan, his withdrawals were inconsistent and reactive. And he was spending a lot of money on things when the markets were up that he truly didn't need. But it was an emotional spending. And once we introduce structure to his planning, and income sequencing is very important, tax planning, having some guaranteed income to stabilize the overall plan, it gave him a plan to follow and at a level that was very comfortable for him. So he eliminated the emotional and spontaneous spending on things that could have derailed his retirement if the markets didn't work favorably long term. So, savings alone, they don't create retirement security. Income planning does. And having a plan is so important. So taxes, timing, and behavior, just as much as returns, is so important. So retirement isn't about how much you saved. It's about how well your income is designed to last. So we build these plans out so they last hopefully much longer than you think you're going to survive on this earth. And they're built out for 30 years, in some cases 35 years.
Yeah, longevity is a very real thing.
Yeah, depending on how young you are when you retire. So those that are fortunate enough to have a pension, it makes it a little bit easier to make your money last as long as you do, including your Social Security. And like I said, my dad's been retired for 36 years, but he had a pension starting at age 60. So it's worked out really well for him, and he was very fortunate. But those without pensions aren't taken to planning early enough in age to hopefully make it work so they live the lifestyle they desire to have in retirement. And that's why I think the sooner you address your planning needs and look into the future with what you're doing today, it's very important because you want to see if it's going to work. You don't want to wait till it's too late to fix it.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.